Yesterday, the world crossed a line most people will miss until it's too late. Central banks now hold more gold in reserve than U.S. Treasury debt. Not more gold than last year. More gold than America's IOUs. That is a regime change. And if we don't clock it now today, we'll get dragged by it later. I'm John A.G., and this is Short Report. For decades, the dollar wasn't just currency. It was the oxygen of trade. Countries parked savings in treasuries because the system promised safe, liquid, unquestioned. That promise only works if the paper is trusted. Now watch behavior, not speeches. When central banks swap treasuries for gold, they're not doing a cute rebalance. They're doing a trust trade. They're saying, we'd rather hold something with no counterparty than lend to the biggest counterparty on earth. That's not normal. That's a flare. Debt has been growing like a leak nobody fixes. Deficits aren't an emergency anymore. They're the baseline. When stress hits, the tool is always the same. Print, expand, roll, refinance. Like a casino handing out free chips, so nobody notices the table is overlevered. So central banks did what adults do when smoke fills the room. They moved to the exit. Gold is that exit because gold doesn't need permission to exist. No signature, no rating, no pay me later. It just sits there, heavy, silent, brutally honest. And the shift isn't about liking gold. It's about fearing the weaponization of paper. Reserves got frozen. Payment rails became leverage. Every finance ministry heard the same message. If you're on the wrong side of geopolitics, your savings can disappear with a keyboard. So they're building a second door. Now, here's why we care. Central banks don't move first to be trendy. They move first to survive. And when they move, the private world follows. Corporations follow. Funds follow. Families follow. Not because they love metals, because they fear being last. That fear is the fuel. And when fear hits the monetary metals, silver doesn't jog. Silver sprints. Silver is the amplifier. Gold is the signal. Silver is the speaker. When trust cracks, silver behaves like a coiled spring getting kicked. Now let's talk about the move that messed with everyone's head. Silver surged, then got slammed in thin hours. Not a gentle pullback, a hard shove. The kind of candle that makes you think, did the story change? No, the story didn't change. The players panicked. Big banks have lived on a comfortable trick. Sell paper claims, manage flow, roll contracts, keep price behaving. When you can create paper supply on demand, you can bully the tape. But there's a problem with bullying reality. Reality eventually asks for delivery. That overnight smash? It wasn't healthy price discovery. It was a reset attempt. Dump paper into the least liquid window, trigger stops, force margin pressure, manufacture fear, buy time. And it works because it attacks reflex. You wake up, you see red, and your brain screams, danger, get out. Markets know it. They don't just trade metal, they trade your heartbeat. So we slow the reflex down and watch the second screen. Physical signals. Because physical doesn't care about our emotions. It cares about availability. One of the loudest signals is the lease rate, the cost to borrow real metal. Think of it like renting oxygen. If oxygen is abundant, rent is cheap. If oxygen gets scarce, rent explodes because people will pay anything to breathe. When lease rates spike, the market is telling us something simple. Somebody needs metal now. Not a paper promise. Not a future date. Metal. That's why lease rates matter more than a one-night candle. And when the market slips into backwardation, when now is more expensive than later, that's not a fun trivia term. That's the market pricing urgency. Now look at the contradiction. Paper price can get shoved down in minutes. Borrowing physical can get more expensive at the same time. That's a grocery store screaming, sale, while the shelves are empty. Which one do we trust? We trust the shelf. It's not only lease rates either. Watch what exchanges do when they're nervous. They don't announce fear. They change rules. They tighten position limits. They raise margin. They say stability. Translation, we want less pressure on delivery. Because if too many players demand metal at once, the system stops looking like a market and starts looking like a default. Shanghai matters here because it's closer to real flow. Industrial pull shows up there faster. So when Shanghai tightens the leash, hear the subtext. Too much leverage is chasing too little metal. That doesn't happen in calm times. Now, the rumor machine always shows up in moments like this. A famous investor sold. It's a grenade designed to stampede the herd. Here's the grown-up filter. Selling is not always bearish. Sometimes it's risk management. Sometimes it's taxes. Sometimes it's rotating from low leverage to high leverage. Even if a big name trims, the macro doesn't rewind. One portfolio decision doesn't change central bank behavior. It doesn't refill inventories. So we don't trade rumors. We trade structure. And the structure is a monetary order shifting under our feet. Here's the connection most people miss. This isn't only a gold story, it's a collateral story. Treasuries are collateral for the world. If trust in that collateral weakens, everything adjusts. Rates, spreads, liquidity. and demand rises for assets that don't rely on promises. When collateral gets questioned, the system does one of two things. It tightens violently, or it prints violently. Either path is friendly to monetary metals over time because both paths scream uncertainty. Fact: when a central bank sells treasuries, it removes a natural buyer from the bond market. Interpretation: fewer natural buyers means the price of debt has to fall until a new buyer shows up. And bond math is ruthless. If demand falls, yields rise. If yields rise, refinancing costs rise. If refinancing costs rise, deficits widen. It's a loop that feeds itself like a treadmill that speeds up every time you stumble. Now here's the trap. The system can't tolerate high yields for long because high yields crush housing, crush corporate debt, crush government budgets. So when yields threaten to run, the system reaches for the same lever: central bank support, balance sheet expansion, liquidity injections, different names, same outcome. That's why this gold shift matters. It pressures the bond market from one side and pressures the printing press from the other. It's like squeezing a balloon. Push in one place and it bulges somewhere else. So ask yourself, if the world is less willing to fund the US at low rates, who becomes the buyer of last resort? If it's the domestic central bank, we get more money creation. If it's the private market, we get higher yields and tighter conditions. Neither outcome is friendly to everything is fine narratives. Now watch what that does to the average person. Higher yields means higher credit card rates, higher car payments, higher mortgage pain. More money creation means higher prices at the grocery store, higher rents, higher "why is my paycheck smaller" energy. Different paths, same punch. Purchasing power gets hit. And when purchasing power gets hit, people start hunting for something that doesn't get diluted on command. That's where metals step in, not as a trade, but as a behavior change. We should also separate what we know from what we suspect, because sounding certain when we shouldn't is how people get wrecked. We know the reserve behavior shifted. We know the market reacted with volatility. We know physical stress indicators can diverge from paper price. What we suspect is the timeline and the trigger. The exact day is always the part that humbles everyone. So we don't pretend we can time the spark, we watch the wiring. Now, if you want a clean mental model for paper versus physical, use this. Paper silver is a ticket, physical silver is a seat. Most days, the ticket feels like the seat because the plane isn't full. But on the day the plane is overbooked, the ticket becomes a negotiation. You might get a refund, you might get a voucher, you might get a polite apology, you don't get a seat. And that's the risk in a squeeze. The market discovers who has seats and who has tickets. Now, miners. Leverage with landmines. Costs, politics, dilution, and especially hedging can cap upside even if silver runs. Many miners produce silver as a byproduct, so they may not behave like a pure silver bet. If we use miners, we stay selective and we size it like risk, not certainty. And here's another open loop. If institutional money starts rushing into the easy paper vehicles, do those vehicles start vacuuming up enough demand to force real metal tightness even faster? Because that's the irony. People chase convenience, and convenience can accidentally stress the underlying. So we watch for the pressure points that can't be faked. Premiums, delivery times, out-of-stock messages, borrow rates, exchange rule changes, spreads between hubs that should be arbitraged flat. Those are the footprints. And if those footprints deepen while the chart tries to hypnotize us with noise, we know what's real. Now, one more thing about psychology. When a system is cornered, it uses volatility like a stun grenade. Up 3, down 4, up 2, down 5. Not because fundamentals are changing that fast, but because they're trying to break our patience. They want us to confuse motion with meaning, so we keep our eyes on meaning. Meaning is central banks choosing hard collateral. Meaning is stress and borrowing metal. Meaning is rule changes that scream too much demand. Everything else is the poker face. Silver is not just a commodity. Silver is a referendum on trust. That's why it moves like it's possessed when the world gets shaky. It sits at the intersection of money and metal, so when trust breaks, it gets pulled from both sides at once. And that's where paper games become dangerous. Because paper markets can settle in cash. Physical reality cannot. If you hold an instrument that can be resolved with dollars, you are still inside the system you're trying to hedge. That may be convenient, but convenience is exactly what gets tested when everyone rushes to the door. This is educational. We manage risk, so we think in lanes. Physical is slow, heavy, honest. It's insurance. Miners are leverage. If the metal rises, margins can explode, but miners carry political risk, operational risk, management risk. Paper exposure is convenience. Convenience becomes fragile under stress. So here's the question we should ask ourselves. If the world is voting against paper promises, why would we build our hedge entirely on paper promises? That's not a slogan. That's a risk question. Because many people own silver that can't be delivered to them. They own a symbol, not a substance. Now, the most explosive part of this setup is the short side. A big structural short is a dam holding back water. As price rises, pressure rises. At first it holds. Then cracks form. Then one day, it isn't a dam, it's a headline. If we're wrong, where will it show first? Not in the chart. Charts can be bullied. It will show in stress signals, borrow rates, delivery delays, inventories, rule changes, spreads between markets that should be tight. That's where truth leaks out. And we're already seeing leaks. Now here's the open loop most people aren't ready for. Central banks aren't doing a weekend trade. They're building a decade of resilience. So if the official sector is already shifting and the private sector is only starting to notice, what happens when the private sector catches up? Because that's the wave that shocks prices. Central banks are the iceberg. Retail is the splash. The tsunami is institutions and corporations deciding they need protection too. And they don't buy small. Now, about those wild forecasts for gold. Don't treat them as prophecy. Treat them as stress tests. What would gold be worth if the system needed neutral settlement again? If you have a mountain of paper claims and a small pile of hard settlement, the reconciliation is either to shrink the paper or reprice the settlement. Most governments choose repricing because shrinking paper means defaults and political pain. Repricing is quieter. It's inflation with better marketing. And if gold re-rates, silver doesn't politely follow. Silver front runs, overshoots, then scares people with volatility. That volatility is not the enemy in a scarcity squeeze. Volatility is the weapon used to shake you loose. They can't manufacture metal, so they manufacture emotion. They want us dizzy. They want us glued to a 1-hour chart like it's a heart monitor. Because if they can get us to sell the idea, they buy time. But time is an escape. If the physical market is tight, time just lets pressure build. Now let's talk about the dip without coping. A top usually looks like euphoria, not stress. A top looks like everyone celebrating and nobody worrying about delivery. This looks different. This looks like a market being forced to breathe through a straw. So the next move matters because it reveals who has control. If price rebounds hard after a smash, sell pressure was artificial. If price stays pinned while physical tightens, the paper market is losing legitimacy. Either way, we learn. Industry will try to substitute and thrift expensive inputs. That's normal. But substitution has a speed limit. You can't redesign the world overnight. A future substitute doesn't help a factory that needs metal this quarter. Timeline is everything. And so is rule change risk. Exchanges don't tighten once and stop. If pressured, they keep tightening. Margins go up. Limits go down. Settlement terms get clarified. Every stability measure is a message. Too many people are leaning the same way. So if we see another tightening move, treat it like a tremor before the quake. Now I want us to think together. If central banks are choosing gold over treasuries, what are they seeing that the average investor isn't? Is it debt math? Is it sanctions risk? Is it liquidity fear? Or is it something darker, like a recognition that the next crisis requires a reset, and gold is the neutral chip needed when the cards get reshuffled? Drop your take in the comments. What's the real driver? Debt, geopolitics, or a coming reset? And here's the second question that splits the room. If a delivery squeeze hits, do you trust paper silver to track the real price? Or do you think we get two prices, paper and physical? Tell me what you believe and why. Now, the risk nobody likes naming, forced cash settlement. When systems get stressed, they find legal ways to survive. The contract says cash equivalent. The rules say extraordinary circumstances. The headline says orderly markets. And the holder learns a painful lesson. You can be right about silver and still get paid in the currency you were trying to hedge. That's not a fairy tale. That's contract reality. So we respect implementation risk. We don't worship the price. We watch the pressure. We don't chase pumps. We prepare for breaks. We don't need the exact day. We need the direction of trust. And trust is moving away from paper. Now watch what happens when that realization spreads. First, people buy gold. Then they look for cheaper gold and find silver. Then they look for leverage and find miners. Then they look for easy exposure and pile into paper. And that last step is where the system gets tested because paper can outgrow the metal. When paper outgrows metal, the market becomes musical chairs. Everything is fine until the music stops. So here's the cliffhanger we should be watching into the next sessions. If price gets slammed again, but physical signals keep tightening, if rule changes keep coming, then the message is simple. The paper dam is cracking, and it's cracking faster than most people realize. And when that dam goes, it won't be a smooth rally. It will be a gap, a violent repricing that makes today's numbers look like a typo. Subscribe to Short Report, because the next update won't be about what someone said. It'll be about what the market did. And when the market does it, the window to react is measured in hours, not weeks. Now watch the overnight sessions closely, because if the next smash fails, that failure is the signal. And once that signal prints, the next move is the one nobody gets to ignore.